Okay, so welcome back to another recorded session. So in this, we're going to be looking at FM September December 2022 past paper exam question two. Okay, so Clover. Okay, so let's read. Clover Co must replace a machine which is essential to its production process. The company has identified two machines of identical capacity but different technology. So the capacity is the same. If machine A can produce 10,000, machine B also can produce 10,000. But the technology is different, which would be more suitable. Only one machine would be purchased in this mutually exclusive investment decision. So machine one, the machine would cost $2 million and would need replacing after 3 years. All right. When its residual value would be $200,000. Maintenance cost would be 52,000 per year in the first year of operation, increasing by 8% per year in each subsequent year. Okay. Annual operating cost is expected to be 300,000 in the first year of operation, would increase by 10% per year in each subsequent year. Machine 2, the machine would cost 2.5 million and would need replacing after 5 years, when its residual value would be $150,000. Maintenance costs are forecast to be $39,000 per year in the first year of operation, increasing by 6% per year in each subsequent year. Annual operating costs are expected to be 248,000 in the first year of operation and would increase by 12% per year in each subsequent year. All right. Other information. Cloverco believes that whether machine 1 or 2 is selected, future replacement machines would in each case be more advanced versions of the machines with identical life cycles. Buying machine 1 would therefore commit the company to a 3-year replacement cycle, while buying machine 2 would commit the company to a 5-year replacement cycle. The residual value of machine 1 is a buyback price from the machine seller that would be included in the contract of sale. The residual value of machine 2 is an estimate made by Clover Co based on existing market information. The technology used in each machine is expected to continue to develop in the future, while Clover Co thinks that it is unlikely that machine 1 would become obsolescent during its 3-year life. The company thinks that machine 2 could be affected by obsolescence towards the end of its life. For both machines, all increases in costs are due to increasing age. Clover Co uses a discount rate of 13% to embrace investment projects, ignore taxation. All right. So this is the scenario. So we have two machines and we have to assess which machine to go for. Okay, so now we are comparing two machines with two different life cycles. So one is for a 3-year life cycle, the other is for a 5-year life cycle. So when we want to compare assets with two different life cycles, ideally what should we calculate? Equivalent annual cost. So let's read the requirement. What are they asking from us? Calculate the equivalent annual cost of each machine's replacement cycle. All right, let's do that. So let's calculate the equivalent annual costs, EAC. So starting off with machine one. So here 0, here 1, here 2, here 3. So what is the investment amount? Investment amount 2 point. We'll take all figures are in 2,000. Sorry, it's 2 million, no? So 1,000. So maintenance cost would be 50,000. Okay, so maintenance 50,000 in the 52,000 in the first year, increasing by 8% from that point onwards into 1.08 to the power of into 1.08 to the power of 2. Right. Annual operating costs expected to be 300,000 in the first year of operations. Operating cost. and would increase by 10% per year in each subsequent year. All right, 300, 36, 3. So what is the net cash flow? 3, 6 and 2, 3, 6, 3. Yeah, right. Yeah, we forgot to take the scrap value. My bad. Okay, so scrap value is given as 200,000. What is the NPV? Equals NPV, open the brackets. What is the discount rate? 13 plus year 1 to year 3 plus year 0. Okay. So this is the NPV. But what do we need? Equivalent annual cost, EAC. How do we calculate? NPV divided by the annuity factor. So 13%. What is the annuity factor for 3 years? 2.361. So what is the equivalent annual cost per year? 1,172,000. That is the equivalent annual cost. What about machine two? Okay, so we can copy the same thing. We can just change the figures. So investment would be 2.5 million. Maintenance cost. What have they said about the maintenance cost? Residual value is 150,000. Maintenance cost is 39,000 per year for the first year. But we are going to be incurring the maintenance cost not for 3 years. This machine is going to be used for 5 years. Year four, and then you have year five. All right. So 39 into 1.06. Then the operating cost would be for the first year 248, increasing by 12%. Equals in PV, open the brackets, 13%, comma, year one, comma, equals NPV, open the brackets, 13%, comma, year one to year five, plus year zero. So what is the NPV? Minus 3,626,000. All right. So did I miss anything? We recheck that. Should be over here, no? All right. So what is the EAC? This divided by the annuity factor, how much is that? 3.517. So what is the equivalent annual cost per year? 1,037,000. Okay, 1,037,000. No, is it? Yeah, 1,037,000. So now If we compare machine 1 and machine 2 per year, which is cheaper, machine 2 is cheaper. Therefore, what should we do? Discuss which machine should be selected by Clover Co. Okay, discuss. Let's what shall we discuss? They're giving 4 marks, so we have to discuss a lot. Okay, so for 4 marks, we have to talk a lot about which machine to choose. So let's talk about it. Let's give the recommendation. Okay. Since machine 2 has a lower equivalent annual cost, it means that following uh machine 2 would be cheaper. Lower, it would be cheaper because it has the lower EAC. Okay. Okay, but what are the problems with this with regards to the other information? Okay, we can mention that. Okay, lower court should also recheck if the scrap value of machine 2 can be achieved since it is just an estimate. Therefore, the accuracy has to be analyzed. Whatever. Okay. Since the technology of these machines would continue to be developed, there is a higher likelihood that going for machine 2 could result in obsolescence closer to the end of the life cycle. Therefore, Clover might face unnecessary costs. All right, fine. We can say that. And then finally, with regards to the life cycle, okay, so since machine 2 has a shorter life cycle, choosing it mm, has a longer life cycle might result in a loss of flexibility to Clover. All right, that's that. Yeah, easy. 14 marks. That next requirement, requirement B. Discuss why discounted cash flow models or discounted cash flow investment appraisal methods are considered to be superior to non-discounted cash flow methods. Once again, not a difficult requirement. Okay, let's talk about. All right. So discounted cash flow, why is it better than non-discounted cash flow? The first, uh, why is discounted cash flow methods better than other methods? The first one is we are taking cash flows into consideration. Cash flows are taken into consideration. Say that discounted cash flow methods are better than non-discounted cash flow methods since it is on a cash basis. So since it uses cash flows. Okay. So we are going to talk about why cash is superior. So cash is a superior method to measure the wealth of the shareholder since it cannot be manipulated by uh, managers like profit. Uh, Therefore, it is a more objective, we can say objective method of measuring investment risk. So they're asking discuss why it's better. So it's for 6 marks. So they're asking only three methods. Okay? They're asking only for three methods. Next, time value of money. Okay. As uh, as time goes on, the value of money changes. Non-discounted cash flow methods do not take this reduction in the value of money, value of money into consideration. Okay. So it does not take into consideration. Okay. Therefore, discounted cash flow methods are superior to other methods such as payback and cost. All right. Final one, we are taking the whole life of the project. We are taking the whole life of the project into consideration. Okay, so when we are talking about discounted cash flow methods, we are talking simply about what IRR and NPV. So the whole life of the project is taken into account. Okay. So discounted cash flow methods take into account the entire life of the project. While on the other hand, methods such as payback ignore cash flows which occur after the payback date. This could result in incorrect decisions being made as cash flows after the payback might be negative, right? Might be negative. Okay. It would also not result in the maximization of shareholder wealth as certain times projects with a longer payback would have higher DVs. Okay, all right, simple as that. Done. Okay, easy. 6 marks. That's it. You don't have to talk too much. You don't have to describe too much. Simply, if you describe it, you get 1 mark for giving this appointment. 1 mark for saying cash flows. We are taking cash flows. 1 mark for saying time value of money. 1 mark for saying whole life of the project. The remaining 1 mark is only for this paragraph. It is very easy. So 6 marks is done. So yeah, with that, this question is also completed. So thanks for watching. See you all in the next time.